Hello everybody, so this is a much awaited video. This is my post Q4 valuation updates and there's more stocks than this that I've reported. So I'm only covering in this video briefly, right? Zeta, Nvidia, Transmedics, SEZL, and the so disaster that Oddity did in its Q4. So we'll talk about Oddity at the end of the video. Let's go. Let's begin. So SEZL. So some good news. I'm pretty happy about that. So as you know, I've called SEZL cheap multiple times on the channel. I was particularly excited when I made this video 2 months ago about SEZL. I've liked SEZL for a while now. Unfortunately for me, they've ran quite a bit now. So it's a plus 35% because they are firing on all cylinders. For buy now and pay later, replacement of credit card companies by these novel payment system. That's not going away anywhere. That's a mega trend. That's a trend in Europe. That's a trend in the US. Gen Z loves it. It's just the way it is. And, a lot of people complain about these companies, say these companies are bad. But in my view, they are better than credit cards. Every time you use these companies to finance a purchase, there is a credit decision that is made. And they don't put people into too much debt that they can't ever get out of. So I actually kind of like these companies. And SEZL, you can see, firing on all cylinders. SEZL, in my spreadsheet, of course, I compare it to Affirm and KLAR, right? I don't have Square in there because Square is not a pure play buy now, pay later. But SEZL, Affirm, and KLAR, they are free pure play buy now, pay later. You can see SEZL is the second cheapest. SEZL is obviously, in my view, a no-brainer. Compared to Affirm, it's better than Affirm. Now, when it comes to SEZL versus KLAR, well, they grow at about the same speed, all of them. The main difference is that SEZL is more profitable, but SEZL, per my spreadsheet, is about 3 times more expensive. So, given that KLAR is actually down 70%, more than 70% since its IPO, I actually prefer KLAR just a little bit right now over SEZL. But SEZL is chugging along, probably trying to get back past 100 like it ran before. This stock is not a broken thesis. This stock is firing on all cylinders, and that's why it's up 35% today. I haven't listened to the call yet, but I will. Moving on to something which to me is entirely nonsensical. It makes absolutely no sense. It's Nvidia. Nvidia is down 5%. After yet again a beat and raise, after yet again a truly stellar conference call, the market was going to drop it no matter what. And this is the unfortunate pattern that we've seen for so many stocks. The market makes absolutely no sense. This has been complete nonsense. The fact that Nvidia would be down 5% after such a quarter is unfathomable. There is no crack whatsoever. Like the analyst tried to ask, is there a crack in the system? Like, what is going on? What is going on? Do you see weakening demand on this or that? The confidence is second to none. Like, there was no negativity whatsoever from Jensen on the call. I don't think you could literally have seen anything negative from this call, yet the stock is down 5%. So the market is not responding to fundamentals, it's responding to traders. Nvidia in my spreadsheet, as far as the Max 7 go by the way, it's with Facebook, it's the second cheapest, actually, slightly more expensive than Facebook, but that's only because I put 48% forward revenue growth. I think analysts, this is my analyst number, I think analysts will increase this to the upside, and then in that case, if Nvidia grows at say 60% in 2026, then they will once again be the cheapest stock in the Max 7. Just complete positivity. Like, even on the call, there was a question. It's like, what about gaming? Are you giving up on gaming? They were asking, and the CFO was essentially saying, sorry, we need the chips for AI. So they're essentially even putting gaming on the back burner so much that everybody's like over-ordering. Everybody's over-ordering. And we have GTC coming, and there's Ruben, right, which is the next product. And they're investing investing heavily. They are building a conglomerate of equity stakes in all sorts of companies in the AI sector. And that right there is second to none, that equity stake that they're building. Analyst on the call asked them, given how undervalued Nvidia is, the analyst asked, why wouldn't you do a buyback? Because you can see they have $60 billion worth of cash. And they're essentially saying they see even better opportunities in investing in the ecosystem than they do in the buyback. So even the analysts on the call, one of them was like, oh yeah, the company's undervalued. You bet the company is undervalued. The market is being terrified because it sees 4.4 trillion, and so it is scared. But if you look at any of these metrics, like EV to gross profit or EV to EBITDA, this is a stock that's cheaper than Walmart. Like, this is cheaper than TJ Maxx. This is cheaper than Walmart. This is cheaper to a lot of stocks that I find make no sense in the market. And Nvidia, of course, is the largest company in the world, but it's about to become even bigger, especially when I think about all the equity stakes they got. So I cannot understand this 5% down. There's liquidity issues in the system. There's a problem with the market. The market has been broken since October of last year, and it continues to be broken. And it's extremely annoying. These companies who are firing on all cylinders and not seeing the benefit, it's extremely annoying. But that's just the way it is. It's fine. Not the first rodeo. Transmedics. Let's talk about Transmedics. So I'm a little bit of a growth snob. So when they guide 20 to 25%, I have a tendency to think it's like a little sad, because I like to see 30% growth in general. But it's still pretty good growth. I mean, let's not kid each other. It's still pretty darn good growth for Transmedics. I think Transmedics has gotten somewhat expensive, and it's not because of a 051. It's because of the sector, right? Healthcare is a sector where especially reimbursed healthcare, insurance-based healthcare. It's a sector where you could have changes in the FDA, changes in CMS, changes in a state law and a state policy, where you could have the revenue. You could hurt revenue really, really bad just by single decision makers. That's why I like to see my healthcare stocks to be very cheap. This one, in my view, is getting a little pricey. It's roughly flat after the earnings call because the company is doing very well under the hood. The execution is great. It's great execution. They do everything they said they did, and then some. They're going to Europe. They're starting with Italy in Europe. They seem to be doing very, very well. With that, they have potentially a new organ coming up, which is kidneys. They're developing a next generation OCS, that's the organ care system, which has kind of been taking over the organ transplant business for the past few years. What's not to love? Well, like I said, what's not to love for Transmedics is the valuation. I find the stock a little expensive here. I would not add to this stock. And also, you may remember when I got into this stock a while back, I was covering this stock much more, like 2 years ago. You may remember I was talking about this stock being a medium-term hold, because in my view, this stock will be disrupted by xenograft. Right? I can think of another stock called United Therapeutics, for example, which invests heavily in this. And xenografts, that's what? That's the pig-grown organs. And we also already see pig heart transplant. I think I think xenografts could be a major threat to Transmedics. And so that's why it's a medium-term hold. This stock for me is still a hold. It's firing on all cylinders, but I find it a little expensive right now. So anyways, moving on to a stock that I definitely don't find expensive. A stock that has been caught up in the SaaS apocalypse, as everybody is calling it, and it is Zeta. Zeta is trading at an enterprise value over gross profit over revenue growth of a 0.15. For a software company, this is dirt cheap. This is unheard of, right? Relative to the sector, 0.15 is actually dirt cheap. And what I love about Zeta is that they didn't give me some lowball guidance. They actually gave me great guidance at 34 to 35% 2026 revenue guidance. And so it works beautifully in my spreadsheet, because I can just take the 35% and I can insert 35%, and I'm getting an EV over GP over RG of a 0.15. And the rule of 40, of course, has been there. It's a 56. So it's a very good rule of 40. They're firing on all cylinders. Everything is growing. everything's growing. They're the king of one-to-one marketing. They can target one person just like that with the perfect ad at the perfect moment, in the perfect city, in the perfect place, in the perfect outlet. So that's why a lot of people compare them to the Palantir of marketing, except Zeta is not used to identify a threat. The Zeta is used to identify a customer and boom, target them with an ad. Or it's used to understand customers, and they launch their own agent, right? Athena, which is also why this stock is getting compared a lot to a Palantir and AIP. And I can see this narrative also develop on the internet, on X. And so as this narrative grows, actually, you could see another stock that's narrative driven, which is Zeta. But right now, Zeta is still very cheap, right? Unlike Palantir, which is by any metric not cheap. And what I love to double down on the love for Zeta is they gave us long-term guidance, 2028 guidance. You can see they're getting more than 2.3 billion in revenue for 2028. So it's 1.3 billion. They're gonna go from 1.3 billion to 2.3 billion in next to no time. So yeah, great quarter, great call. I actually listened to part of the call, the management discussion I listened, and it's up 16% after that quarter release, and it's understandable. It's well deserved. The market is reacting positively on this one, and it's reacting consistent with the report, unlike Nvidia, where the market is not reacting consistently at all with the report. And then moving on to another stock, you see the market has made some sense. Okay, now the market is also reacting consistently with the Oddity disaster. Let's talk about Oddity. I know a lot of you have been asking me about Oddity. So if you're on the Patreon, I posted about this as soon, a few hours after, because I had to dig into it. But I made my decision on Odd, and it's easy for you to know what my decision is, because for me the deal breaker was I didn't even need to read into the issue. Like when you have a company that's over time, I've been following this company for years. They would always guide between 20% and 25% top line and 20% to 25% adjusted EBITDA income, right? Adjusted EBITDA. They called it the 2020 model. They had this 2020 model. They had this reasonable growth model where they were going to grow 20% top line, also while maintaining a 20% adjusted EBITDA. So I was expecting the steady Eddie usual stuff, and then they stun me, they stun everybody, guiding minus 30%. So how did you go from, Q3, everything was well and done, and you say it's 20%, usual growth, long-term growth rate, long-term top-line growth rate is 20%, and then you move from 20% to minus 30%. So that was enough for me to make the decision. Now, of course, there's been a lot of aftermath online as to what actually happened. And the CEO was not too specific on the call. But allegedly, from what I've read online, from posts that are not, I'm not a meta expert, right? And some people were saying theories about TikTok. I'm not a meta expert. But allegedly, they were kind of put in a penalty box, allegedly, for their ads, such that the customer acquisition cost went absolutely through the roof as some sort of a allegedly punishment, because I don't know what's sour, but something went sour with a try before you buy ad. So this. I'm still stunned, honestly, by this, and I'm not the only one stunned. I mean, the internet seems very stunned, and of course, a few people had been negative on the stock, and they come out and they say, "Oh yeah, I told you all about this 2 years ago because someone made a random tweet 2 years ago about an issue." But I'm stunned. I don't understand. I honestly don't understand. How do you go from 20% long-term trajectory? It was not a one-time 20% either. It was a long-term 20%. How do you go from that to minus 30%? And also other people are wondering online, shouldn't there have been some sort of a warning, some sort of a profit warning? Usually when there's such a material event, usually you hear about it before the call. So that's also why why I think a lot of people were very surprised. So anyways, I agree with analysts. I saw there was a slew of downgrades today for Oddity. Top analysts from top institutions like JP Morgan, like Bank of America. I mean, not that I praise the analysts, but you had some big names behind this stock. And so they say now it's a 2027 issue. It probably won't make a comeback until 2027. I entirely agree with that. We're entering probably a valley of despair for this stock until they get this advertising issue figured out. So now we wait for Q1, and we see. I think the stock is just going to be dead money for a long while now until we get that issue sorted out, which is too bad because they're doing so well under the hood. They have brand free. They have AI. They have a lot of proprietary stuff, but if you're put allegedly once again in a penalty box for ads, such that your ad engine doesn't work anymore, well, you can't grow anymore. You can just maintain your earnings, and sure, on a P ratio, I think the P ratio is 6. Right? If I have my metric, enterprise value over EBITDA is like a 7. It's entirely ridiculous from a value investor standpoint. I think this could attract value investors, but I'm not a value investor. And also, I put 1% in there because my spreadsheet doesn't work for negative revenue growth. So that's why I put 1% in there, because for negative revenue growth, I get NA. That's all I get. So I'm not equipped to analyze a negative revenue growth company. Hence, the decision was very quick to make for me. I think this is a stock where there will be over entry opportunities if we actually find out that they fixed the issue. But allegedly, a lot of people seem to think what's going on with the ads. I don't know what's going on with the ads, but clearly it's a shock. It's a big shock. So HIMS doesn't look too bad after all, if that makes some sense. And I'll conclude with this. So this stock right down 55% in 5 days. And if you go back, say 2 months, 3 months, it's down 70%. So many growth stocks are in this situation, right? Duolingo is a famous one. You have ServiceNow, which is down like 55%, but you don't have that. You have KLAR. KLAR also is down 70%. HIMS is down a lot. Like the market has gone crazy too. Like this time, I think it's warranted. I think this drop is warranted. But in general, the market has been absolutely brutal for anything innovative. Even today, EOS, right? EOSE. I'm probably going to analyze EOS because that looks interesting now. EOS, doesn't it? And it dropped more than 40% today. So pretty much similar to what Oddity dropped when the Oddity, most of the midday, that earnings day, was down 45% on average most of the day. That's pretty much the same drop, except EOS doesn't seem to have as bad of a problem. So the market's gonna punish you no matter what. It's a very brutal market. But in this case, I believe this drop is warranted. Because I'm a growth snob. I was in this company for growth. I was absolutely not in this company for value. What am I expecting? A buyback? Am I expecting a dividend? No. That's not why I was in this company. So there you go. All roads lead back to HIMS in the DTC space. And DTC, the market had a big scare with HIMS. And, cool-headed. I was like, yep, I'm sticking with HIMS. I'm still sticking with HIMS, and I'm so glad. I'm so glad Oddity was not a major position ever for me. I'm so glad HIMS was always a big position for me. But anyways, HIMS is way down. But I have full confidence in HIMS. HIMS to me will absolutely get back. This one, I think it's entering a valley of despair. This reminds me a lot of Enphase back in the day when they had that issue with installers having overstocked. If you remember Enphase, when I was covering Enphase, this reminds me a lot of Enphase. We could have a year and a half of valley of despair, and then if a product is good, which it seems to be, then it could make a comeback. So anyways, this was not financial advice. You understand why I say that. It's absolutely not investment advice. Actually, I think you would have to be crazy to be it's not. It's not financial advice. I am not a financial advisor. This is only entertainment. I'm an entertainer. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching. and have a wonderful, wonderful day.